Joining me right now to react is former Council of Economic Advisors Chairman and Brent R. Nicholas Distinguished Fellow in Economics at Stanford University's Hoover Institute, Kevin Hassett, Georgia Congressman and member of the House Budget and House Energy and Commerce Committees, Buddy Carter, and Wells Fargo Investment Institute Head of Global Investment Strategy, Paul Christopher. Still with me, of course, is Ryan Payne, Kelly O'Grady, and Cheryl Casoni. Kevin Hassett, your reaction to the numbers.
Right. This is exactly what you and I have been talking about for the last few months, Maria. Inflation is actually, if you look at the monthly numbers, accelerating. Supercore last month in December showed up almost at 5%. If you take the latest core number and you annualize it, then 2 months in a row, you're running close to 5%. And so I think that what really needs to happen, I just don't understand what's going on with federal funds futures, is that somebody needs to slap the markets in the face and say there is no way they're going to be cutting rates, every meeting from late spring until Christmas. It's just not going to happen. And I think that the slap of the face is a little bit visible in markets today, but I think that really federal funds futures need to almost start to price in hikes because inflation seems to be accelerating to me. If you look at the year-over-year number, last thing, you're taking off, months from a year ago that have a big effect on that year-over-year number. And so I like taking the last 3 or 4 months and annualizing. And if you do that, then it looks like it's accelerating.
Paul Christopher, your thoughts?
Yeah, if you get the soft landing thesis that's been running around in the market for the last year, there's just a logical inconsistency. If we only slow gradually, then people are going to want more homes. They're going to want more services of all kinds. That's going to push home prices higher. It's going to push labor costs higher. That's going to keep the services portion of the CPI still elevated. So you're going to get much slower disinflation, much stickier inflation going forward, and that's what the markets have to contend with now. They've been ignoring that logic.
Congressman, how much to blame is Congress on this? Buddy Carter, with all the money flowing, many people say one of the issues for inflation is the fact that there's way too much fiscal stimulus out there.
No question about it. When the government spends more, you have less. And that's a well-known fact. And let's keep in mind now, when we talk about inflation, when this administration took office, inflation was at 1.4%. Prices are continuing to go up, and they're not going to come down. I talk to retailers all the time who say, we're not lowering our prices. We're going to keep them the same. The people in America are just stressed with this. This is just crushing our economy. Mm-hmm. This administration, and especially Congress, we've got to stop the spending.
Kelly O'Grady, how do you see it?
So one of the things that Cheryl mentioned was food. And in fact, in the report, it says 4 of the 6 major grocery food indexes have increased month over month. I mean, fruits, vegetables increased 0.4%. And so what does that tell you? Every time you go to the grocery store, you're feeling that. And I think about what's going on in voters' minds as they're going to the polls, this election season, and the fact that that is continuing to rise, they're feeling that every single time. And that, you add in the shelter piece. I'm one of those millennials, right, that is renting instead of buying a home for that exact reason. And you just feel all of your money go out the window. And I can imagine that is happening in the minds of young voters where President Biden is struggling to connect with right now.
Ryan, how do you see it?
I think 100%. I mean, socioeconomically, it doesn't matter where you are on the scale. I think it's really hard to buy a home right now. It doesn't matter if you have a banking job or, you're working in a service job. It's an overall problem, and I agree with that. But I do want to but mention the positive as well. Inflation has come down a lot over the course of the last 12 months. And I think most importantly, if you start looking at wages versus inflation, the last 2 years you had it where you definitely had inflation outpacing wages, and that was a big problem. But you're starting to see the other effect now where wages are outpacing inflation. And I think that is the longer term trend, which does bode well for the economy. But having stubborn shelter and food costs, that hits every American, and that's a big problem, I would say, for the Biden administration as you come into this election year.
Cheryl, take a look at yields right here. You got the 10-year up 12 basis points, Cheryl, on this number. That is what is causing the stock market to sell off. We're kissing up to 4.3% again on the 10-year right now, Cheryl.
We are, and again, that drop that we saw as far as the U.S. interest rate futures after that CPI data is something else I'm watching, and this kind of goes in line with what we're seeing in the Treasury market, is the fact that Kevin Hassett will appreciate this. Look, the bets are coming off the table that you're going to get that rate cut in the month of March. I mean, I was watching that right after it cuts. At this point, they're still kind of betting on June, Kevin, but even that might be a little Pollyanna based on the numbers that we're seeing here. Because remember that Fed Chairman Powell 2 weeks ago said, well, we've got 6 months of good data. This is good. But, you know, we're on a path to rate cuts, a path. He didn't say that we're actually going to be hitting those rate cuts sooner rather than later. You know, you got to wonder at some point if the Fed told us they were telegraphing 3. That's what the dot plot told us. You got to start to wonder when you see numbers like this, guys, and that's what I think the market is reacting to along with the Treasury market. I don't think we can so much bet even on that June cut anymore. I mean, we've got a little bit of time, but these numbers don't make that case.
So what do you want to do from an investment standpoint for your portfolio, knowing that perhaps we could see a spike in inflation down the road? We could see a slowing in the economy down the road this year.
Yeah, it's a really good question. And basic blocking and tackling would tell you that at this point, with the market having run the way it has, and a lot of investors with exposure in communication services or IT or even the consumer discretionary sectors that have really run hard, now is a great time to be taking some profits and putting that cash to work in sectors that we think have longer term benefits like industrials and materials, healthcare and energy. We think those will be builders of the U.S. economy in the years to come, and they're really underpriced right now.
Kevin, what do you want to do in terms of your own portfolio, in terms of this inflation impact? Do you think inflation spikes further on in the year? What does 2024 look like to you in terms of this data?
Yeah. I think that basically the 10-year needs to be in the 5 range to be in equilibrium. That if you look at the old Taylor rule, which tells the Fed what they need to do to get inflation under control, then they've been 1.5% or 2% below it this whole time. They stopped way too soon, and that's why inflation is not really heading towards the target. And so, you know, eventually inflation is going to stay higher, in which case yields are higher, or the Fed's going to try to be more attentive to the Taylor rule, in which case rates are going to be higher. And so rates have got to go up. And you know, where does the inflation come from? Again, you know, previous panelists have said it. It's a supply-demand thing. So in housing, you know, nobody can buy a house because interest rates are high. That's how interest rates work. And so everybody's lining up to rent, and so therefore you can lift rents. And you know, at the macro level, the government's spending like you know, it's running out of business and it's getting ready to get everything off the shelves. So think about it, it's kind of like the Vietnam War spending in Ukraine, and that kind of stuff drives inflation. And so inflation's not going down. Interest rates have to go up. That's not so good for equity markets.
Well, that's a great point that you make in terms of the package going to Ukraine. That's more money sloshing around the economy. Too many dollars chasing too few goods. You think that's going to add to the inflationary worry?
Well, at the margin, sure. You know, but government spending, look at all of government spending. Look at the CBO report that just came out, you know, highlighting that we've got these massive deficits as far as the eye can see. So the only way the government's going to get ahead of the curve on that is to inflate it away unless we get an austere government, which doesn't look super likely right now.
Yeah, we're still down 28% from 2023. Ryan, and I know that's one of your good points, but look at this market. Just year to date. In 2024, the Nasdaq is up better than 6%. The S&P 500 is up 5.25% this year. So even a bull like you is looking at this and saying, "Hold on, maybe it's time to sell into some of this," right?
No, I don't think you do.
Because you were nodding your head when Paul Christopher was saying, "Take profits."
Well, in tech, I agree in tech. I mean, I made this stat earlier in the show, but I mean, Microsoft is at $3.1 trillion. It's worth double the entire energy sector in the U.S. And if you look at free cash flow for the energy sector, it's like $135 billion versus only $67 billion from Microsoft. So you know, there's getting some disproportionate gains in the market right now that probably need to be righted at some point, where there's so much value in other places. Healthcare is going to have phenomenal earnings this year. You know, you mentioned healthcare as well. So I think, you know, really diversifying your money away from big tech, which I don't think investors will do, by the way. I think they'll blindly keep buying big tech here. Maybe I'm a cynic. You have $7 trillion still sitting in cash, and if the Fed does cut later this year, where's that money going to go? It's going to go to the S&P 500, which is disproportionately weighted to big cap tech. But now is the time to start being proactive in your portfolio.
Congressman Buddy Carter, weigh in here on all of this congressional spending. We just saw the Senate pass the $95 billion aid package to Ukraine and Taiwan and Gaza. Is that going to pass in the House?
No, and I doubt that the speaker will even bring it up. I hope he doesn't, because we don't need to pass that. We made it clear in the House that we are not going to pass more foreign aid to other countries to secure their border until we secure our border. When I am at home, people ask me all the time, why are you sending money to other countries to secure their border when our border is not secure? We have made that perfectly clear in the House. The Senate is obviously not understanding that. We are serious.
Yeah.
I hope that the speaker will not bring this up.
Kelly, jump in. What are you watching?
So two things. One is I'm looking at new vehicles in the data that increased 1.0% here. And I think back, we're talking about the federal aid package, all of that money flooding. What about the strikes that we just saw, right? The increase in wages, that's going to roll down. You're already seeing that number increase. Now, we did see used cars and trucks decrease 1.3%. But I wonder if that's going to cause even more inflationary pressures as we see all of these rising wages across different industries trickle down to the consumer. The other thing, going back to your point, Ryan, about the markets, I hear you on being bullish, but when you look at what we heard from a number of companies, I think it was all 9, when you talked about healthcare, in the S&P 500, they were revising their guidance down, and it was negative guidance, in that next quarter. Now, I know you want to set the expectation so the market doesn't fall when they come out and they say, okay, we didn't do as well. But that is something that's sort of rattling around in my brain.
Cheryl, what do you want to say in terms of this rent number and energy as well? The underlying problem with all of these inflationary readings is energy, oil, right?
Yep, it is oil. I mean, you might get a little bit of a fall in nat gas prices, which we did in this report, but that's not really helping the overall story that we're getting with CPI. So two things. Yeah, you mentioned the rent story, to Kelly's point about having to rent. That was also up 0.6% month over month. That is a huge problem. But to the energy issue here, look, the Biden administration could turn this ship around, pun intended. First off, with the Middle East situation and the Red Sea that you talked about earlier, but also think about what they're proposing now, and they're getting sued for it, by the way, by API. They are, they're offering 3 federal leases in the Gulf of Mexico. 3. Okay, if you want to see better energy prices at your gas tank, you've got the facilities, you've got the production available here. They won't do it. You know what they want, Maria? They want wind farms in the Gulf of Mexico. That's what President Biden wants. So I don't know. Yeah, it's an election year. You want to appease all the greenies out there, fine. But this is your average American voter that's going to the grocery store and filling up their tank, and they're like, wait a minute, come on. This is not, this is the inflationary problem. And Bank of America, by the way, just did a survey which points to exactly that. They said the biggest transactions they're seeing in credit cards for January, guess what it is? It's the gas tank. It is the grocery store. But the Biden energy policy problem is front and center, I think, in all of this.
Cheryl, I know you're going to also be focused on retail sales and the PPI later on in the week. I want to talk about the consumer for a moment, Kevin, because you made the point that we are seeing the effects of a higher inflation. It likely will spike down the road. Is that what it's going to be to stop this powerful consumer that we've been watching? We've got retail sales coming out on Thursday.
Right. Well, we've already talked a little bit about wages, and I just want to remind people of the historic pattern in inflationary cycles, which is that inflation goes up, wages trail, real wages go down, and so therefore people have to borrow to keep their standard of living going. Eventually, inflation starts to drop, but it gets stuck at wage inflation, more or less, and stays there until the unemployment rate spikes and wage inflation drops too. And so right now, as we mentioned, wage inflation is reasonably strong, and that's kind of, like the net under the trapeze artist for inflation, and that's where we're going to stay until unemployment goes up and the consumer, then it has to slow down because they just don't have the money anymore. And so right now it looks to me like we're pretty far from that scenario, and so we're going to continue to see months like this until the unemployment rate starts to go up. And might be it doesn't go up until the Fed hikes above where they are right now.
Now, I guess I want to see the same question from you, Ryan, and Paul, Christopher, in terms of your thoughts on retail sales and the consumer right here, Paul.
So we talked at length about the wages and the link to inflation, and all of that is very true and very correct and relevant. But there's another factor here, and that's liquidity. Consumers still have quite a bit of cash, if you exclude the bottom 2 income quintiles, so the bottom 40% of income earners, and you start focusing on the middle class, those voters and higher, they still have quite a bit of cash to spend. And so as that grows, as that cash pile grows smaller, then you'll start to see some of those impacts. You'll see fewer sales, lower retail sales, then more layoffs, and then you start to see the unemployment rate increase. So liquidity really has to be accounted for here.
Ryan, what do you think?
I think there's some truth to that, but I think we discount how strong the labor market's going to continue to be because we have a labor shortage in this country, and that's not going away, and that's demographics. And if you looked at productivity gains last year, they were off the charts. They were like 2.7%. I think it averages like 2.1% in a normal year. So I think with all the technological advances, we talk about AI, and then we talk about looking at earnings even going out into the future, the efficiency that the American worker is going to have over the course of the next couple of years is going to be a bona fide boon. So I think you're going to see strong wages, but productivity is going to keep inflation in check. And I think that's what a lot of people are missing right now. And I think that if that purchasing power is strong this year, and I think it will be for the American consumer, this economy is going to be hotter than expected again this year, just like it was last year.
And you look at the Atlanta numbers, right? Kevin Hassett, the Atlanta tracking the economy. I don't know where they come up with these numbers, but it's not slowing down. I mean, it's off of the highs. It was all the way up to 4.9%, right? Now it's like what? The Atlanta...
Right.
3.7% tracking this quarter.
Kevin, do you believe that number in terms of growth for the economy?
I do, and it's actually, we've been talking a lot of negatives, and you had also sort of asked, like, what am I doing with my money? I think that comment about AI is something we really need to pay attention to. There are a whole bunch of new studies at the National Bureau of Economic Research, and many of them coming out of Stanford from some of my colleagues out there, that are studying firms that integrate AI into their production process and finding that within a month or two, they get 20% productivity gains. And it's happening across a wide variety of industries. And so against all this interest rate inflation talk, there is a really positive supply shock that's underway in the U.S. And if you go back and look, it was almost exactly 30 years ago that Netscape introduced the Navigator, and then we had 5 years in a row where equities went up about 30%. And if you look at the Silicon Valley people, the people like Bill Gates and Eric Schmidt, they're all saying AI is bigger than the internet. And I think that that's something that market says, there's always a tug of war between the argument for up and the argument for down. But there's a lot of argument for down right now. But I think we might have one of the stronger arguments for up that I've seen since the 90s.
Yeah, it's a great point. Congressman, are you and your colleagues working on AI in terms of the regulatory front?
No question about it. The Energy and Commerce Committee and the Communications Technology Subcommittee that I serve on, that is one of the things that we are concentrating on. AI is the buzz at the Capitol right now, not only in our committee, but in every committee. And every committee is going to be different because AI impacts different sectors in different ways. So that's why, you say, oh, let's just give it to Homeland. No, we can't do that. We've got to make sure that every sector is looking at this. Maria, if I could bring up one point, I had the opportunity yesterday to have lunch with a group of first responders. And let me tell you, this economy is crushing them. They were all just concerned about rent, concerned about mortgage, concerned about food, concerned about gas. And these are our heroes. And yet this economy is crushing them right now. The price of a signature meal at Chick-fil-A is up 21% over the last 2 years. And let me tell you, when you start messing with the price of chicken in South Georgia, you move from being nosy to meddling. And I'm telling you, you meddling now.
Yeah, it's a great point. And one other issue to watch is the potential for supply shortages of that. Kelly, I remember when you were reporting on the supply shortages, what was it, like a year ago? And you actually saw the impact of those ships not being able to deliver what they needed to deliver and how it rippled through the economy.
Yeah, it was really, really crazy. I spent many a day outside the LA port on your shore when it was dark. But, you would see that line of ships. And that means that retailers have to kind of guess when it comes to ordering their inventory. Then all of a sudden, all those ships arrive and you have this surplus of inventory and they're sort of scrambling to figure out what's the right thing. And so what you're seeing right now with with what's happening in the Red Sea. I know that it feels really far out. You don't see that visual that we did outside the LA port, but it's the same type of thing. If you let that keep going, your ships get delayed. They have to go around Cape Horn. It takes longer. It costs more. And that's ultimately going to trickle down to the consumer. You might not have a bunch of ships waiting outside LA, but you're certainly going to see those prices if we let that go on for too long.
Cheryl, that's what I've been worried about. The inflation spike to come because of the hostilities in the Red Sea.
Exactly. I was just looking back through the energy picture again. You know, look, OPEC, a headline just crossing that OPEC is reaffirming where they're at as far as their production. Sadly, we have to look to OPEC, because we're not producing domestically, and they're leaving it right where it is. They think, there's a great global economic outlook. That's according to OPEC. So take that at face value. Also, to Congressman Buddy Carter's comments about food. I mean, if you look at meat prices, this is for everybody, but of course for our first responders. Yeah, they're paying 7.7% more than they were a year ago for beef, for veal. Meats in general are up 3.5%. Poultry, to his point, up more than 2%. I mean, these numbers are really crushing to the average American. The one thing I will say about, as far as the ship story that Kelly was talking about, we have seen a better supply chain issue, but that's not the problem. The problem is what you're seeing on your screen, and it's what you're paying for energy and food.
Yeah, and that's what's moving markets. Look at this market here, down 353 on the Dow Jones Industrial Average right now. The NASDAQ also down in the triple digits. We are looking at a decline in stocks on the heels of a spike in interest rates. Kevin Hassett, how high can rates go? You mentioned 5% earlier. Is that what you're expecting on the 10-year?
Right. Well, I think that if you go all the way back to the 1800s, then a good rule of thumb is the inflation rate plus around 2% is what all the interest rates are. And so if you think the inflation rate is hovering around 4, which is about what it seems to be, and it's not really going down from there very fast, and then you add 2, then that means interest rates should be around 6. But maybe if you think interest rates are the 2% should be added to 3, then it should be hovering around 5. But I don't think that the long end of the curve is really like doing anything that pays attention to history right now, and is going to have to adjust because the Fed doesn't have inflation under control. Again, if they lift the federal funds rate even higher, then the long rates are going to go up, and if they leave it where it is, then inflation is going to go up and the long rates are going to go up.
Kevin, it sounds like you're really not expecting a cut in interest rates.
No, I'm really not expecting a cut in interest rates. I would be surprised if they're able to cut the interest rate this year. No, I don't think they can cut it this year. The economic data have a lot of momentum. The inflation data are sticky. I don't see where the rate cut comes from.
So if you don't have a rate cut, and this market is betting on rate cuts 3 to 6, okay? If there's a surprise of no rate cuts, how significant a sell-off would you expect, Ryan?
First off, I think it's election year. I'm hard-pressed on getting at least one rate cut this year. But I would say that 5% interest rates are normal, by the way. We just got used to low interest rates. And stock markets did phenomenally well before the great financial crisis when we had 5% interest rates. So I think the Fed has just normalized monetary policy as opposed to, we use tightening, but I call it normalizing. Kevin, I want to hang with you, man. We have a lot of the same views. But I think bottom line is the market can do exceptionally well if we have strong economic growth and we have strong productivity and we have normal interest rates. I don't think that's crazy.
Yeah, but look, this market is partly where it is because of this expectation of a cut in interest rates. You can't deny that. Paul Christopher, if you don't get those cuts, are you going to see a stock market sell-off later this year?
Yeah, you'll see the market contract some, and that would be part of a normal market year anyway, 7 to 10%. That's what we should expect. We want to be ready with that rebalancing cash that I mentioned earlier to put it back to work. And we still think the S&P will be right around 5,000 by the end of the year, but it will have to really make adjustments for the inflation sticking around longer and for interest rates perhaps many fewer than what the market's currently pricing, as the panel has correctly pointed out.
The NASDAQ right now down 1 2/3%. That is 302 points lower. The Dow down 363, just about 1% lower. Congressman Buddy Carter, as we wrap up here, what is your priority in the Congress? We've been talking about this wide open border and this need to secure the border. It doesn't look like that's happening.
Well, it's got to happen. Otherwise, there's not going to be supplemental funding, at least not coming from the House and the Republicans in the House.
So then we'll see a government shutdown. Are you expecting a government shutdown March 1st or March 8th?
I hope not. I hope we don't. But There would be worse things that could happen, and that wouldn't. Look, I was at the border last week. I'm going to tell you, it's worse than this is my 8th trip in 10 years. It is as bad now as I've ever seen it, and we've got to do something about it. This is a crisis in our country.
I wonder if a government shutdown would create panic in the markets, or would they just ignore it, Ryan?
I think a lot of things could create panic in the market short term, but I think when you look at the overall macro view right now, I'm hard pressed to think that there's still $7 trillion sitting in cash. When you net out inflation and taxes, you're making really nothing on your money if you're getting 5%. And you've got earnings growth double digits this year and probably going into next year. And if you take the Magnificent Seven out of it, valuations are historically normal to cheap. As an asset allocator, I'm like a kid in a candy store. This is one of the better opportunities we've had in my lifetime and any investor's lifetime to get invested. I'd say don't wait here and be paranoid, sit on the sidelines. That's what investors did last year, and it was a big mistake.
Hey, you've been right so far, so I'm not going to go against your advice there. But Kelly, look, they've got to finish these appropriations bills. The deadlines are coming. The clock is ticking, March 1st and March 8th.
Yeah, you know, I'm with Ryan. I'm not sure that we would see that fluctuate in the market because I also think we've seen this happen so many times, right? Of, oh, we get close to it. No, but we're saved. I do want to put the Magnificent Seven, though, Ryan, back into the conversation because I think if you don't see those rate cuts, as the panel, some are circling around, that we may not even see a rate cut this year. The Magnificent Seven, they're not going to stop investing in AI. That is what is bolstering their shares. And I think then what you're going to see is what we saw this past year, right? The year of efficiency, which could mean more layoffs in order to make sure that they can afford that investment in AI.
Yep. Kevin, final thoughts here in terms of what you are focused on in terms of the right read on economic growth for 24.
I think that I just want to say that we all have to remember that if the Fed can't cut rates because the data are strong, then that strong data is a reason for the market to be optimistic about profits and so on. And so when you say, okay, if everything stays the same and we don't cut rates, then how bad is it? And then the answer, you're right, Maria, is really bad. But the not cutting rates is going to happen because profits and everything are surprising on the upside. And so a little bit down feels about right to me.
I think I agree with you, Ryan, that we'll see at least one cut. I mean, I think the Fed really wants to cut, at some point. But Kevin is making the right point. Inflation is still a problem. Cheryl, where are we on inflation?
Well, obviously, the story is not good as far as the inflation picture goes. And I will say final thing about AI, just really quick. Companies are cutting jobs because they're investing in AI. That's a consumer story.
Great point. All right, great conversation, everybody. Kevin Hassett, Congressman Buddy Carter, Paul Christopher, Ryan Payne, Kelly O'Grady, Cheryl Casoni. We so appreciate everybody's all hands on deck this morning.